It's Thursday, 13th of August, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day.
Right. And we have a lot of ground to cover today.
We really do. We're seeing major tremors across Wall Street this morning, specifically driven by sudden leadership vacuums at two of India's largest conglomerates.
Yeah, the overnight sentiment has been completely hijacked by these exits.
Exactly. So let's start with the Tata Group. N. Chandrasekaran announced he is going to step down as Tata Sons chairman when his current term ends, which is in February 2027.
Right, wrapping up a massive decade-long tenure.
And the market reaction was immediate. We saw Tata Group stocks fall up to 4% across the board.
Which is, it's a direct reflection of how institutional investors price in predictability. I mean, over the last decade, Chandrasekaran didn't just manage the group, he orchestrated a really aggressive, highly capital-intensive transformation.
You're talking about the massive aviation bets.
The aviation bets, the Air India turnaround, yes, but also pushing billions into semiconductors, into electronics manufacturing, their digital businesses.
Right.
I mean, these are not asset-light software startups. These are heavy industry bets. They have gestation periods that last a decade.
Yeah, building a semiconductor fabrication plant or, completely restructuring a legacy national airline, that takes years before you see a single rupee of real operational profit.
Exactly. So when the primary architect of a strategy that requires that much sustained capital suddenly announces an exit, well, the risk premium on the stock instantly skyrockets.
Because investors hate a vacuum.
They despise it. I mean, institutional investors are suddenly forced to calculate the friction of a transition period. They're asking, will the new leadership have the exact same risk appetite?
Right. Will they delay the semiconductor rollout?
Precisely. The market hates unanswered questions. So what do? They discount the stock price immediately by that 4% we saw to account for that unknown variable.
But, the shockwaves weren't just limited to heavy industry today. If you look at the fast-moving consumer goods sector this morning, it's brutal. Godrej Consumer Products saw its shares plunge 10.6%.
Yeah, that was a massive slide.
It's their steepest single-day decline in 6 years. And this was driven entirely by the abrupt exit of their CEO, Sudhir Sitapati. So I look at the FMCG sector right now, and it feels like we are watching companies try to change the engine of a massive cargo ship while it's moving at full speed.
I'd actually argue it's worse than that. It's like changing the engine while steering straight into a hurricane.
A hurricane.
Yeah, because the consumer goods space is facing brutal margin pressures right now.
Right, inflation on raw materials and all that.
Exactly. And a CEO like Sitapati was brought in specifically to execute a turnaround in this highly uncertain consumer landscape.
But I have to push back on the math here just a bit. Are investors just, too emotionally attached to star CEOs? I mean, does a sudden 10.6% drop accurately reflect the mathematical risk of a disrupted strategy, or is this just pure panic selling?
No, it is entirely mathematical. It's not just emotion.
Really? 10.6% just on math?
Yes, because when institutional investors build their discounted cash flow models for a company like Godrej, right, they aren't just looking at the brand heritage. They are pricing in the specific execution roadmap of the current leadership team.
I see.
You're losing the exact operational blueprint that the market had already factored into its valuation. So that 10.6% plunge is just the market aggressively repricing future earnings.
Because the probability of an execution misstep just went up significantly.
Exactly. Markets abhor a vacuum, like you said.
Okay, so we have this sudden market drop driven by leadership panic. But if we pivot from the boardroom drama directly to the hard numbers, there's a weird paradox here.
The Q1 earnings.
Yes. The actual Q1 corporate earnings are telling a surprisingly robust story of growth. Let's look at this divergence. Tata Motors saw its commercial vehicle profit jump a massive 83%.
Yeah, but we do need to unpack the mechanics behind that 83% jump.
Sure.
Yes, it was driven by robust commercial sales, meaning they are actually moving more heavy trucks and fleet vehicles on the ground.
Yeah.
But a really significant portion of that massive percentage jump was boosted by a mark-to-market gain on their investments in Tata Capital.
Okay, let's clarify what mark-to-market actually means for a listener who is tracking these quarterly reports. We are basically talking about paper profits, right? Based on the current valuation of those investments rather than just raw operational cash from selling more trucks.
That is the crucial distinction you have to make. Think of it like this. If you own a house and the property value goes up, your personal balance sheet looks fantastic, right?
Right.
But you don't actually have more cash in your pocket to go buy groceries unless you sell the house.
Right. The liquidity isn't there yet.
It's exactly. Mark-to-market gains strengthen the corporate balance sheet. But as an investor, you must separate operational cash flow from investment valuation gains.
Fair enough. But even with that caveat, the underlying operational side for Tata Motors was still undeniably strong.
It was. It was a very solid quarter structurally.
And the strength is not isolated to the auto sector either. Grasim Industries saw its consolidated profits surge over 51%.
Driven by building materials.
Right. Continued strong traction in their building materials, plus their financial services businesses. And then you have Apollo Hospitals reporting a 38.4% rise in consolidated profit.
Also very strong.
So if we look at these diverse sectors, I mean, we have auto, building materials, healthcare. It's like taking the vital signs of the broader Indian economy. If all these critical organs are posting massive double-digit profit growth, why is the broader market acting so incredibly jittery?
Well, because historical earnings are essentially the rear-view mirror.
The rearview mirror, okay.
Yeah. They confirm that the previous quarter's vital signs were excellent and that the domestic economy is humming along nicely. But financial markets are inherently forward-looking mechanisms.
Right.
Right now, the market is staring straight through the windshield, and it is entirely distracted by the global macroeconomic storms brewing ahead.
You're talking about the global liquidity shifts.
Liquidity shifts, the geopolitical tensions in the Middle East, and of course, U.S. inflation metrics dictating where capital flows next. So the earnings show domestic resilience, absolutely, but the market's current pricing reflects global anxiety.
Well, if global markets are so jittery, capital usually runs for cover. But here's where the data gets fascinating for India.
Yeah.
While the broader stock market looks over its shoulder, foreign money is quietly flooding into India's banking system. Listen to this. Bank deposits in India just grew at a staggering 15.4%.
That is the fastest pace in nearly a decade.
It's massive. But what's driving it?
The mechanism driving that 15.4% growth tells a much deeper story. It is not just organic domestic savings suddenly spiking because everyday citizens are putting more of their paychecks into savings accounts.
Right. It's not local retail money.
No. Overseas Indians have been aggressively parking funds in foreign currency-linked non-resident deposits. We call these FCNR deposits.
Right. FCNR, foreign currency, non-resident accounts. Let's break down why that matters so much to the listener who is tracking domestic banking liquidity right now.
Well, an FCNR account allows non-resident Indians to deposit money in foreign currencies, so like U.S. dollars or euros, rather than converting it to Indian rupees.
Which means the depositor takes on zero currency exchange risk.
Exactly, zero risk. And to bring these dollars into the domestic system, the Reserve Bank of India created a special, highly attractive window for these specific deposits.
So the RBI is actively pulling this money in.
Yes. The RBI essentially incentivized Indian banks to offer better yields to attract these foreign dollars, and it is working flawlessly to boost domestic liquidity.
Meanwhile, the macroeconomic storm in the U.S., which, let's face it, dictates so much of this global capital flow, is actually showing signs of braiding.
Right, the inflation data.
Yeah, U.S. consumer inflation eased in July. And this downward trend was primarily driven by falling gas prices and, volatile oil markets calming down a bit.
Which is huge for the Fed.
Right. This cooling inflation gives the U.S. Federal Reserve much-needed flexibility to finally execute those interest rate cuts we've been waiting for, which immediately triggered a percentage rally across Asian equities.
A significant rally, yes.
It almost feels like U.S. inflation data acts as a global financial thermostat. I mean, if the U.S. finally cools down, does it mean emerging markets in Asia can finally take off their heavy winter coats and see some unhindered capital flow?
The thermostat analogy is apt, but the mechanism is what you really have to watch here. When the U.S. Fed lowers interest rates, the return on safe U.S. Treasury bonds drops.
The yields go down.
Exactly. So, trillions of dollars of institutional money suddenly need a new home that pays better rent. That capital is virtually forced to hunt for higher yields in emerging markets like India. So yes, a cooling U.S. thermostat is a major relief.
But I hear a however coming. You have that look.
There is a major however. I would strongly caution against declaring a sudden summer for Asian markets just yet.
Why is that?
Let's look back at that Indian deposit surge we literally just discussed.
Yeah.
The 15.4% jump.
Right, the FCNR deposits.
The fact that domestic banking liquidity requires these targeted, incentivized foreign FCNR inflows to sustain its credit boom, That highlights a structural vulnerability.
How so?
Because India's domestic credit growth, the rate at which banks are lending money for cars, for homes, and for corporate expansion is highly aggressive right now. To fund all those new loans, banks are increasingly reliant on these overseas dollars rather than just domestic organic rupee deposits.
Ah, so it's hot money, essentially.
Exactly. If global sentiment shifts, or if competing markets suddenly offer better yields, that foreign liquidity tap can turn off overnight.
And the threat to that global sentiment is immediate when we look at the physical trade side of things. I mean, the optimism of a cooling U.S. economy is being directly challenged by raw geopolitical reality right now.
Absolutely.
During the previous trading session, Indian stock indices closed in the red, experiencing a broad percentage slide.
Across the board, yeah.
And the primary driver wasn't domestic weakness, it was foreign portfolio investors aggressively offloading shares. Why? Due to rising crude oil prices and escalating tensions in the Middle East.
This is the historical Achilles heel for the Indian macro narrative. It always comes back to this.
Oil.
Oil. India imports the vast majority of its crude oil. So when Middle East tensions escalate and crude prices spike globally, it acts as a direct, unlegislated tax on the entire Indian economy.
Because it hits everything from logistics to manufacturing.
Right. Every incremental rise in crude oil widens India's current account deficit. And foreign portfolio investors, they know this math perfectly.
They can see it coming a mile away.
Exactly. They see the rising import bill, they calculate the negative impact on corporate margins and domestic inflation, and they pull their capital out of Indian equities to de-risk their portfolios.
Yet, despite that foreign capital outflow, and despite the rising cost of crude, the Indian rupee managed to end modestly higher in percentage terms against the dollar.
Yes, it did.
But how exactly does a currency gain strength when its main import is getting drastically more expensive and foreign investors are actively selling off domestic assets? That doesn't make sense.
Because that strength doesn't happen organically in this kind of environment. It is entirely engineered by the Reserve Bank of India.
The RBI stepped in.
Heavily. The RBI aggressively intervened in the currency markets. They essentially opened up their foreign exchange reserves, aggressively sold U.S. dollars into the open market, and bought Indian rupees to absorb all that downward pressure.
Wow. That is a heavy-handed defense.
It is a defensive, highly calculated maneuver. By artificially strengthening the rupee, the RBI ensures that the crude oil we buy in dollars doesn't become exponentially more expensive in rupee terms.
Right, which prevents imported inflation from just spiraling completely out of control.
Precisely.
But, I mean, it requires incredibly deep pockets to fight the global market like that day in and day out.
It does. India's forex reserves are strong,
Yeah.
but you don't want to burn them unnecessarily.
And speaking of fighting for vital resources, the physical geopolitical chessboard is getting incredibly tense. We have Saudi crude exports from the Red Sea literally going dark.
Yeah, this is a massive development.
By going dark, we mean massive oil tankers are intentionally turning off their tracking systems to avoid Houthi attacks. And simultaneously, Russia is issuing explicit warnings to Europe against seizing its commercial ships.
The rhetoric is escalating quickly.
Very quickly. And right in the middle of this, India is showing deep strategic interest in cooperating on Russia's Northern Sea route.
Which is fascinating timing. But we really have to unpack what happens when those Saudi tankers go dark in the Red Sea. It isn't just about stealth. It triggers a massive financial chain reaction.
Right, because if you are an insurer and you're covering a tanker that's traversing a literal war zone with its GPS tracker turned off, your risk models just break.
They completely shatter. Marine insurance premiums skyrocket. And because of that, shipping lanes are being diverted thousands of miles around the Horn of Africa, and global supply chains just slow to a crawl.
Which brings us back to India's inflation problem.
Exactly. This Middle East squeeze directly raises India's oil import bill, which, as we just discussed, forces the RBI to burn through its dollar reserves to defend the rupee, completing that entire vicious cycle we just outlined.
It almost sounds like global trade routes are turning into a high-stakes game of Monopoly. I mean, if the Red Sea, let's call it boardwalk, is blocked, does whoever controls the icy Northern Sea route suddenly hold the most valuable real estate on the board?
The monopoly analogy totally holds, but the stakes here are survival, not just rent. The physical geography of global trade is being forcibly redrawn by conflict right now.
So the Arctic route becomes a lifeline.
Yes. In this context, India's interest in the Arctic Northern Sea route is not just polite diplomatic maneuvering with Russia.
Right.
The Arctic route can cut transit times between Europe and Asia by weeks compared to going through the Suez Canal. It is an absolute economic necessity. Diversifying trade routes is the only mathematical way for a massive importer like India to hedge against the choke points currently paralyzing the Red Sea.
It's all about finding alternatives before you get squeezed out completely.
Precisely.
Okay, so we have these treacherous earthly trade routes, we've got shifting capital yields, and unpredictable leadership changes driving the markets today. Let's look up from all this terrestrial friction for a moment.
Let's do it.
Because our deep dive wouldn't be complete without examining a major technological breakthrough, and today's takes us straight to the stars. Scientists have just discovered a way to turn the Starlink satellite network into a giant scanner for Earth's upper atmosphere.
The sheer ingenuity here is fascinating. I mean, researchers are literally repurposing existing commercial infrastructure.
How does it work, though? I know they are using orbital data from roughly 1,200 Starlink satellites to successfully map the ionosphere,
Right.
which is a layer of our atmosphere that is notoriously difficult and, frankly, expensive to observe using traditional scientific instruments. But what is the actual mechanism here? It sounds like they are using millions of tiny commercial flashlights to accidentally reveal an invisible ceiling over the Earth.
That flashlight analogy actually captures the physics of it perfectly.
Yeah.
So these Starlink satellites are constantly beaming radio signals down to Earth to provide broadband internet, right?
Right. Just beaming Wi-Fi down to the surface.
Basically, yes. And as those specific radio waves pass through the upper atmosphere, the ionosphere, they experience very, very slight delays and signal distortions
Based on what?
based on the density of the charged particles they encounter in that specific layer.
So because the signal is literally bending and slowing down as it hits thicker patches of atmospheric plasma.
Precisely. It's basic physics. By analyzing the minute degradation and the delay of these internet signals across 1,200 different orbital paths simultaneously, scientists can reverse engineer the data.
That is wild.
Right. They track exactly how much the signal degraded and use that math to build a real-time, highly detailed 3D map of the atmospheric conditions.
That is incredible. They are essentially reading the distortion of a commercial internet signal to measure the health of the atmosphere.
It is a massive leap for near-Earth space weather forecasting and climate science, but it also introduces a rather provocative reality about our technological footprint.
Oh, I see where you're going with this.
Yeah. Consider how humanity's aggressive push for commercial, high-speed internet in space has inadvertently created the most comprehensive, high-resolution environmental monitoring system we've ever possessed.
It really makes you wonder. I mean, if these commercial satellite networks are inadvertently mapping our upper atmosphere today with such incredible precision, what other forms of accidental surveillance are these massive corporate mega constellations conducting that we haven't even realized yet?
It's a great question.
We're building digital infrastructure in space, but we are also quietly building a planetary panopticon.
It is a total accident of corporate ambition. We aimed for faster broadband, and we accidentally built an Earth-sized scanner.
It's amazing.
It proves that in technology, just like in the markets, the unintended consequences are usually where the real story lies.
Very true. From the uncertainty of corporate boardrooms to mapping the invisible layers of our atmosphere, it all comes down to finding predictability in the noise. And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.